In 2008, the global economy appeared powerful, but underneath the surface, a dangerous financial bubble was growing. Banks were lending enormous amounts of money, making home ownership easier than ever for millions of Americans. As demand increased, house prices climbed rapidly, creating the illusion that real estate could only move upward. Banks began approving risky mortgages for borrowers who sometimes struggled to repay their loans. These risky loans became known as subprime mortgages, and their numbers grew at an astonishing speed. Most people did not realize that these mortgages were becoming connected to the entire global financial system. Banks bundled thousands of mortgages together and transformed them into complex financial products called mortgage-backed securities. These securities were sold to investors around the world, spreading American housing risk far beyond the United States. Many of these products received high credit ratings, making them appear safer than they actually were. Financial institutions also borrowed heavily, using enormous leverage to increase profits and magnify potential losses. As long as house prices kept rising, the entire system seemed profitable, stable, and almost unstoppable. But by 2006 and 2007, housing prices began falling, and the first cracks appeared inside the financial system. Millions of borrowers began missing payments, causing mortgage losses to spread rapidly through banks and investment firms. Banks suddenly discovered that assets they believed were valuable were becoming extremely difficult to sell. In March 2008, major investment bank Bear Stearns collapsed and was rescued in an emergency deal. Then came September 2008. Lehman Brothers filed for bankruptcy, creating one of the biggest shocks in financial history. Fear spread through financial markets as investors realized that even giant institutions could suddenly disappear. Insurance giant AIG also faced collapse, threatening enormous losses across the global financial system. Banks became afraid to lend to one another, causing credit markets to freeze across the world. Stock markets plunged as investors rushed to protect whatever money they could. What began in America quickly became a global crisis, affecting banks, companies, governments, and ordinary families. Companies struggled to obtain credit, investment declined, and unemployment began rising across many countries. Governments and central banks were forced to intervene with emergency measures to prevent an even larger collapse. Massive rescue programs were introduced to stabilize banks and restore confidence in the financial system. Even after emergency actions, the global economy entered a severe recession that affected millions of lives. Millions of people lost homes, jobs, savings, or financial security during the aftermath of the crisis. Governments responded with new financial regulations, designed to reduce excessive risk and strengthen banks. The crisis revealed how deeply connected modern financial systems had become, across borders and continents.
The biggest lesson was simple. When financial risk becomes invisible, problems can grow until everyone feels them.
The 2008 crisis proved that a problem inside one market can become a threat to the entire world.